Hello and welcome to another session of the My Solo 401k Financial YouTube webinar series. Thank you so much for joining. If you're on YouTube, if you could please like and subscribe, we'd really appreciate that. Please chat over questions in the chat as we'll go through the questions after we run through these slides. If you're watching as a recording, or if you're watching and you can't stay, you can always come back and watch the recording. It's the same link. So today's topic is a great topic. It is how much income do I need to maximize solo 401k contributions? It's a very common question. Today's session is specifically focused on businesses that are taxed as a partnership or a multi-member LLC, someone who reports their self-employment income on a Form 1065 and they're getting a K-1. So let's jump into it. So the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Again, the topic is how much self-employment income do I need? And we're going to go through some resources, the solo 401k basics, contribution factors and limits, so we can understand the later slides where we go through the scenarios and examples. So first off, we have our community. You can join us every day at mysolo401k.net/my community. We have forums where you can post questions 24/7. We host daily Zooms at 1 p.m. Pacific, 4 p.m. Eastern. Today's, of course, is here on the YouTube channel. We have a video and webinar library with hundreds of videos and webinars. So it's a great place to learn and to share the knowledge. So to lay the foundation, who's eligible to set up a solo 401k? Well, you have to be self-employed with no full-time W-2 employees working for any business owned by you or a spouse, if any. In terms of some of the top considerations, do I need a separate entity? No, you don't. We have many, many clients who operate as sole proprietors, so they don't have a formal legal entity. You do need to report earned self-employment income on your taxes. That could be on Schedule C if you're a sole prop. It could be a W-2 if your business is taxed as an S Corp, or in the case of a partnership, on line 14 of your K-1. There's technically no minimum amount of earned self-employment income that you need in order to be eligible to set up a plan. But of course, if your goal is to make contributions, as you'll see as we go through the slides, you can't save more than you earn, right? So your ability to contribute is a function of your earned self-employment income. A spouse or a business partner can participate as long as your spouse or business partner is reporting their own earned self-employment income. You can have a solo 401k even if you have a W-2 job, even if you participate in your W-2 employer sponsor plan. Again, as long as you've got that separate earned self-employment income. What are the top solo 401k benefits? Well, of course, contributions, like we're here today to focus on. And as you can see, as we go through the scenarios, I mean, you're going to be able to contribute as much as $66,000 or even $73,500 if you're 50 or older for 2023, which can be made as a pre-tax, as a Roth, as a mega backdoor Roth. You can invest in alternative investments like real estate, notes, private placements. As part of the onboarding process, we're helping clients open up accounts at the bank or brokerage of choice where they have checkbook control so they can act quickly to take advantage of investment opportunities. And then, of course, lastly, our plan allows for being able to take a solo 401k participant loan. So this is where you can borrow the money and use it for any purpose. In terms of what those terms are, you're able to borrow up to 50% of the balance, not to exceed $50,000. It has to be documented as a loan. We prepare the required loan documents as part of our service for no additional charge. It needs to be paid back in monthly or quarterly payments. It's up to you. Equal payments of principal and interest. Those payments are spread out over a 5-year term. And the interest is either prime plus 1%, or it could be a CD rate plus 2%. Now, digging in more to the contributions, in considering how much you can contribute, one's ability to contribute to a solo 401k depends on different factors. One would be your self-employment income, right? You can't save more than you earn. And we'll talk about what that means for a partnership here in a moment. Another would be your age, right? Once you're 50 or older, you can save as a catch-up contribution. The catch-up contribution limit for 2023 is $7,500. Whether you participate in another plan, like a day job plan, because that'll impact your ability to make employee contributions. And then lastly, the type of contribution you're looking to make. Are you trying to make pre-tax, Roth, or after-tax? So digging deeper into what self-employment income means, it depends on how your business is taxed. So for a self-employed business taxed as a partnership, self-employment income is equal to line 14 of the K-1 less 1/2 of the self-employment tax. Now, you don't consider W-2 wages like from your day job. You don't consider investment income like Schedule E type income. And let me just make sure we're not having audio issues. Thank you so much. So thank you so much for your patience. All right. So looks like the audio is still okay, but maybe the video went out. So thanks for that. Again, just to emphasize, self-employment compensation is equal to line 14, code A of Schedule K-1, less 1/2 of the self-employment tax. And then of that number, you're going to be able to make the different types of contributions. For example, if you're trying to make pre-tax employee contributions, the limit is 100% of your self-employment compensation, not to exceed $22,500 or $30,000, because you're able to make a catch-up if you're 50 or older for 2023. Now, that employee contribution limit applies at the employee level. So you need to reduce it by any contributions made to another plan, like a day job 401k plan. Now, that obligation to reduce it by contributions made to another plan does not apply if it's a 458 governmental plan. That employee contribution could be made as a pre-tax contribution, could be made as a Roth contribution. If it's going to be made as a Roth contribution, it needs to be deposited into a separate sub-account. Another type of contribution is an employer contribution, also referred to as a profit-sharing contribution. For a self-employed business taxed as a partnership, like a multi-member LLC, where the income is reported on a 1065 and then K-1s are issued to the partners, the limit for employer contributions is 20% of the self-employment compensation. So you first have to run that pre-calculation, line 14 of the K-1 less 1/2 of the self-employment tax, and then 20% of that amount may be contributed as an employer contribution. Now, of course, the total of all contributions, the employee, the employer, the voluntary after tax, can't exceed the overall limit, $66,000 or $73,500 if you're 50 or older in terms of 2023 contributions. Now, in contrast to the employee contributions where you have to aggregate and consider contributions made to another plan, like a day job plan, your ability to make employer contributions to the solo 401k is not impacted by contributions made to another plan, like a day job plan, unless, of course, those other contributions are made to a 403b plan. In that case, all contributions made to the 403b, whether employee, employer, as well as contributions made to the solo 401k, can't exceed the overall limit. Now, a good question that comes up is, what about the new ability to make employer contributions as Roth contributions? So as of the end of last year, under Secure Act 2.0, employer contributions can be made as Roth contributions. But for a plan like ours that allows for mega backdoor Roth contributions, this change offers no substantive benefit. And that's because you're able to more quickly reach the overall limit by making contributions as after-tax contributions, because you're able to contribute 100% of your self-employment compensation dollar for dollar as an after-tax contribution, whereas we just saw the employer limit is a percentage, right? It's 20% of your self-employment compensation. So you would need $5 of self-employment compensation to justify every $1 of employer contributions. In terms of the deadline, they're equal. So there's no benefit of making those employer contributions as Roth contributions. And you also have more flexibility, because if you want to transfer the after-tax contributions out of the solo 401k to a Roth IRA, you can do that. There's no triggering event that has to be met. Whereas if you're trying to transfer Roth employer contributions out of the solo 401k to a Roth IRA, you would need to meet a triggering event, such as being at least 59 and a half years of age. And then, of course, there is uncertainty in terms of how to report those employer Roth contributions, whereas there is no uncertainty as far as how to report after-tax contributions. In short, you don't report after-tax contributions when the self-employed business is taxed as a partnership. So for all of those reasons, again, there's no substantive benefit of making employer contributions as Roth contributions. And then, of course, lastly, the third type of contribution is voluntary after-tax contributions, which is how one makes mega backdoor Roth contributions. The limit there, as we just referred to, is 100% of your self-employment compensation, dollar for dollar, up to the overall limit, which is $66,000 for 2023. Now, of course, you have to consider any other contributions made to the solo 401k. You have to make sure that the total amount of employee, employer, plus the voluntary after-tax doesn't exceed the overall limit. What's interesting is the catch-up contribution. So when you're 50 or older and you have the self-employment income to make to justify that catch-up contribution, which is $7,500 for 2023, that $7,500 catch-up contribution would not be made as an after-tax contribution. Instead, you would either make it as a pre-tax employee or a Roth employee. But for purposes of aggregating, you don't have to consider that. So in other words, you might be able to make a $7,500 Roth employee catch-up contribution if you're 50 or older, and then still make the $66,000 after-tax contribution. So you're still getting to that $73,500 contribution amount. What's also interesting is whether it's impacted by contributions made to another plan, and it's not, as long as the other plan is not a 403B plan. So unlike your employee contribution limit, where you have to reduce it by contributions made to a day job plan, your ability to make after-tax contributions is not reduced by contributions made to a day job plan. So even if you've maxed out your day job 401k contributions, you can still make the $66,000 after-tax contribution as long as you've got the self-employment income to justify it. Unless, of course, the contributions made to the day job plan is a 403B, in which case, again, you have to aggregate all types of contributions made to the 403B, along with all types of contributions made to the solo 401k, and the total amount cannot exceed the overall limit. And then lastly, voluntary after-tax contributions, like Roth contributions, need to go into a separate sub-account. So this is how folks end up with 3 different sub-accounts, right? They might have pre-tax funds, Roth funds, and then a third voluntary after-tax account. All right, so now that we've laid the foundation, let's start to go through the scenarios before we turn to the good questions that you're chatting up. So with our first scenario, this individual wants to maximize the solo 401k contributions while keeping their self-employment income as low as possible. So we're assuming that their self-employed business is taxed as a partnership, or a multi-member LLC taxed as a partnership, where the income's reported on a Form 1065 and a K-1 is issued to each partner. Here, let's assume it's just one participant in the solo 401k who does not make contributions to another plan like a day job plan, and they want to contribute 100% of their self-employment compensation to the solo 401k. Again, self-employment compensation is line 14 of the K-1, less 1/2 of the self-employment tax. And let's assume that they only want to make those employee contributions, those salary deferrals. So how much self-employment income would they need? Well, if they're under 50, they would need $24,211 reported on line 14 of the K-1. Reducing that amount by 1/2 of the self-employment tax would result in self-employment compensation of $22,500. They could then contribute 100% of that amount as an employee contribution. Could be made as a pre-tax or as a Roth. Now, if they're 50 or older, then they would need $32,281 of self-employment income reported on line 14 of the K-1. After reducing by 1/2 of the self-employment tax, that would result in $30,000. So their self-employment compensation figure for purposes of making solo 401k contributions would be $30,000. And then they're going to be able to contribute 100% of it. So $22,500 plus an additional $7,500 catch-up contribution, which could be made as an employee, either pre-tax or Roth. All right, scenario number 2. Again, the individual wants to maximize those solo 401k contributions while keeping self-employment income low, right? So it's the same basic assumptions, right? Partnership or multi-member LLC tax as a partnership, one person who doesn't contribute to another plan, like a day job plan. They want to contribute 100% of their self-employment compensation, but now make both the employee and the employer. How much self-employment income would they need? So if they're under 50, they would need $30,263 on line 14 of the K-1. When they run that pre-calculation to reduce that amount by 1/2 of the self-employment tax, that's going to result in an amount of $28,125. They could then contribute $22,500 as an employee, and then 20% of that same amount, which is $5,625 as an employer. If they're 50 or older, they would need $40,351 reported on line 14 of the K-1, and then reduce that amount by 1/2 of the self-employment tax will give them $37,500 of self-employment compensation. And so of that amount, they could contribute $30,000 as an employee, right? Because they get the catch up, plus 20% of the same of that self-employment compensation figure, which is another $7,500. But that second $7,500 would be made as an employer contribution. So in both cases, they're still contributing 100% of their self-employment compensation to the solo 401k. Scenario number 3. Now let's assume this individual just wants to maximize and hit the max and make it as a pre-tax contribution. So again, we're assuming that their self-employed business is taxed as a partnership. It's just one person who doesn't make contributions to another plan, like a day job plan. Again, they want to put it all in as a pre-tax to reduce the taxable income, filling up both the employee as well as the employer bucket. So how much self-employment income would this individual need? So regardless of whether they're 50 or older, they would need $230,520 reported on line 14 of the K-1. When they reduce that amount by 1/2 of the self-employment tax, their self-employment compensation figure is $217,500. So of that amount, if they're under 50, they can contribute $22,500 as an employee contribution, plus 20% of the same figure, which is $43,500 as an employer. So at the end of the day, they would have made $66,000 of pre-tax employee contributions, reducing their taxable income. Now, if that person reporting that same amount of self-employment compensation was 50 or older, they could make an additional catch-up contribution of $7,500. So now they would contribute $30,000 as a pre-tax employee, and then still the same 20% of $43,500 as a pre-tax employer. Again, now they'd have $73,500 of pre-tax employee contributions that they made to the solo 401k. So now let's go to the last scenario. Here, this individual wants to maximize those Roth solo 401k contributions. Let's presume that their self-employed business is taxed as a partnership. It's one person who doesn't make contributions to another plan. And again, they're focusing on making Roth contributions and or voluntary after-tax contributions. Here would be a good point to note that, again, we're assuming that the individual is not making employer contributions as Roth contributions, because with our plan that allows for the mega backdoor Roth, there's no substantive advantage of doing so. So how much self-employment income would this individual need to maximize those Roth solo 401k contributions? Well, if they're under 50, they would need $71,018 reported on line 14 of the K-1. This would result in their self-employment compensation amount being $66,000. This person could then contribute 100%, dollar for dollar, up to $22,500 as a Roth employee contribution. They're going to skip the employer contribution amount and then make the difference, which is $43,500 as an after-tax solo 401k contribution. They could then transfer that after-tax solo 401k contribution over to the Roth solo 401k sub-account. So at the end of the day, they'd have $66,000 in their Roth solo 401k. If they're 50 or older, how much self-employment income would they need to report on line 14 of the K-1? $79,088. Once they reduce that amount, they run that pre-calculation by 1/2 of the self-employment tax. That would result in self-employment compensation of $73,500. This person could then contribute 100%, dollar for dollar, up to $30,000 as an employee, because they're putting that catch-up contribution in as an employee. And then they could do the difference up to $73,500. So another $43,500 into their voluntary after-tax solo 401k sub-account. And then that amount would be moved over to the Roth solo 401k sub-account. So at the end of the day, they'd have $73,500 in their Roth solo 401k. All right, great. So that takes us through those different scenarios. Before we turn to the good questions, again, we just want to highlight some of the resources. We have our community where it's free to join. All are welcome. mysolo401k.net/my-community. You can also reach out to us by email, by phone. Again, we've had a couple, this is the third in our series of sessions. We did one about 10 days ago, focused on businesses taxed as an S Corp or a C Corp, or an LLC taxed as an S or a C. We also did a second session focused on sole proprietors, single member LLCs, those who receive income as a 1099 independent contractor. So please check us out on our YouTube channel. You'll be able to access those full recordings there. So now let's go to the good questions. Thank you so much for bringing the good questions and all your good participation. Again, if you're on YouTube, please like and subscribe as we post videos every day. All right, so I have a W-2 and I'm a realtor as well that wants to open a self-directed 401k. The realtor income fluctuates annually. How can I maximize the contribution? Can I take earned W-2 income from my primary W-2 income to contribute to my solo 401k? So I'm assuming that you have a W-2 day job and you also receive self-employment income as an independent contractor, maybe as a 1099 NEC income. So you cannot use W-2 wages to justify contributions to the solo 401k. In other words, you would have to have that self-employment income to justify it, but you wouldn't literally have to take the money out of that 1099 income stream and contribute it to the solo 401k, right? You could take money that was in your savings and use that to justify the contribution. What's helpful for those who have that, it's because it's not uncommon, right? The self-employed individuals have income that fluctuates, is that the contribution deadline is not until the business tax return deadline, including any timely filed extension. And that's for all types of contributions, whether it's employee, employer, voluntary after tax. So in contrast to a 401k plan that someone might have at a day job where their employee contribution has to be made by the end of the year, self-employed individuals have up until the business tax return deadline, including any timely filed extension, to make all types of contributions. And that's clear based on the IRS publication 560. There's a chart on page 3 that makes that clear. And it makes sense, sort of practically speaking, because a lot of self-employed individuals don't know how much they made until after the end of the year. So you could set up the plan, for example, now for 2023, and then once the end of the year has come and you know how much income you're going to report, then you could go ahead and make those solo 401k contributions for 2023 anytime up until your business tax return deadline, including any timely filed extension next year in 2024. Hopefully that helps. Thank you so much for bringing the good questions. I've contributed to the Roth IRA for my wife and I. Can I still do the mega backdoor Roth contribution? Absolutely. So when someone makes a Roth IRA contribution, that's not going to prevent or preclude them from also making a mega backdoor Roth solo 401k contribution. Of course, it's subject to the rules, right? You have to have the self-employment income to justify the contribution to the solo 401k. You have to make it into a plan like ours that supports the mega backdoor Roth. The contribution has to go into a separate sub account. When you move the money from the after-tax account to the Roth account, that's a reportable event. And we prepare the required reporting. It goes on a Form 1099-R. We prepare that required reporting as part of our service for no additional charge. As far as where the funds literally have to come from, money's fungible, right? So it can come from the personal account, it can come from the business account. What's key from a solo 401k perspective is that you have the self-employment income to justify that contribution, that it's made within the limits by the deadline. You're making it into the separate sub account if it's an after tax as opposed to a Roth. You have a plan like ours that allows for that type of contribution. And we're very hands-on in helping our clients with all these mechanics. So hopefully that starts to shed light on it. Thank you so much for the good questions. Next question. If I have a daytime job that I contribute $22,500 to the Roth 403b, can I contribute $66,000 or $43,500 as a maximum voluntary? Good question. So typically when you make employee contributions to a day job plan, it doesn't reduce your ability to make voluntary after-tax contributions. Let's take a look at that voluntary after-tax limits slide. So we'll scroll back to that. But the one exception to that would be contributions that are made to a 403b. So any contributions that are made to a 403b, it could be made by the employee or an employer contribution that's made on behalf of the employee. All of those are aggregated with contributions made to the solo 401k, and the total amount cannot exceed the overall limit. For example, $66,000 for 2023. So yes, it would be different if the daytime plan was a 401k. In that case, you could max out the 401k day job salary deferrals, so those employee contributions to your day job 401k. And if you had the separate self-employment income to justify the solo 401k contribution, so as long as you have at least $66,000 of self-employment compensation, you can make a full $66,000 after-tax contribution to the solo 401k because it's not, again, impacted by contributions made to the day job plan, unless, of course, it's a 403b. So hopefully that helps. That takes us to the end of the questions that have been chatted up. We really appreciate the good participation. Thank you so much. We'll stay for another minute or so to see if there's any more questions. Again, please continue to participate. Like and subscribe on YouTube so you get notification of the daily videos and these deep dive webinars. You're welcome to come to our community, mysolo401k.net/my community. We have a Zoom call every day at 1 p.m. Pacific, 4 p.m. Eastern. We have forums where people are posting questions 24/7. So there's a video webinar library. We've got hundreds of videos. So there's lots of great resources, lots of great ways to learn and to share the knowledge. So thank you so much. All the best, everyone. Take care.